This is a quiet money guide, not another urgent promise that one simple answer can explain every price increase. Inflation feels personal because it appears in groceries, rent, fuel, bills, and the quiet realization that the same income buys less. In economic terms, inflation is a sustained rise in the general level of prices across many goods and services. It is usually measured with a price index that tracks the changing cost of a representative basket over time. One expensive product does not automatically mean the whole economy is experiencing inflation. Your personal experience can also differ from the official rate because every household spends money differently. Someone who spends heavily on rent and energy may feel more pressure than someone whose largest costs remain stable. Lower inflation does not usually mean prices are returning to their old level. It normally means prices are still rising, but more slowly than before. Inflation rarely has one cause, even when public debate searches for one person, company, government, or policy to blame. One common cause is unusually strong demand, when buyers want more than the economy can comfortably produce. If restaurants are full, factories are near capacity, and customers keep spending, businesses may find it easier to raise prices. Demand can strengthen after incomes rise, credit becomes cheaper, government spending increases, or people release accumulated savings. The problem begins when demand grows faster than available workers, materials, transport, housing, energy, and productive capacity. Inflation can also begin on the supply side when essential inputs become scarcer or more expensive. Rising oil, electricity, food, shipping, or raw material costs can spread through many industries at once. Businesses may then pay more for production, refrigeration, packaging, transport, buildings, and labor. Some firms absorb part of the increase through lower profits, while others pass part of it to customers. Supply chains create similar pressure when shortages, port congestion, factory closures, or missing components disrupt ordinary production. Wars, extreme weather, crop failures, disasters, and trade disruptions can reduce supply even when consumers have not increased demand. Wages are another part of the story, although their role is often described too simply. Higher wages do not automatically create inflation, especially when productivity rises and businesses produce more value per hour. Pressure is more likely when labor costs rise much faster than productivity, and firms repeatedly raise prices to protect margins. Workers may also seek higher wages because prices have already risen, making cause and effect difficult to separate. Housing becomes an inflation source when too many people compete for too few homes. Rents, construction costs, mortgage conditions, planning limits, and local shortages can all influence housing inflation. Because housing contracts adjust slowly, official measures may keep showing pressure long after conditions first changed. Exchange rates matter because a weaker currency makes imported goods and foreign-priced commodities more expensive in domestic money. That can raise the cost of fuel, food, machinery, electronics, and materials without stronger demand inside the country. People often explain inflation by saying that governments or central banks simply created too much money, a phrase that can contain part of the story but is incomplete by itself. New money creates stronger inflation pressure when it supports spending that outruns the economy's ability to produce. Too much money chasing too few goods is therefore a useful starting point, but not a complete diagnosis. Expectations can influence inflation because people make decisions today based on what they believe costs will do tomorrow. Businesses expecting higher costs may raise prices earlier, while workers expecting higher living expenses may negotiate larger wage increases. Landlords, suppliers, and lenders may also build expected inflation into contracts that remain in place for years. Expectations do not magically create every price increase, but they can make an existing problem more persistent. Business pricing power matters because some companies can raise prices without losing many customers. During a confusing inflationary period, some firms may widen margins while customers struggle to judge whether increases are necessary. That can contribute in particular sectors, although profits alone do not explain every broad inflation episode. In reality, inflation often combines demand, supply, wages, housing, exchange rates, expectations, policy, and business behavior. The mixture changes over time, so the correct explanation for one period may mislead in another. Economists often compare headline inflation with measures excluding volatile categories such as food and energy, which can reveal persistent trends without making those essentials unimportant to households. Price indexes use average spending weights, so an item matters more when households collectively spend more on it. The basket is updated because products, services, and spending habits change, making inflation data an estimate rather than a perfect photograph. High inflation often hurts people with limited flexibility because essentials absorb more income, while wages may adjust slowly. It can also erode cash savings when the interest earned fails to keep pace with rising prices. Borrowers with old fixed debts may sometimes benefit, but new borrowing often becomes more expensive when interest rates rise. Many central banks therefore aim for low and stable inflation rather than permanently falling prices. Persistent deflation may sound attractive, but it can weaken spending, profits, wages, employment, and the ability to repay debt. When inflation falls from a high rate to a lower one, prices usually keep rising, only more slowly. Central banks can restrain demand through interest rates, but they cannot directly produce energy, housing, food, workers, or computer chips. Because inflation can have several causes at once, there is rarely one painless lever that fixes everything immediately. It is normal if this still feels complicated, and future Quiet Money guides will return to measurement, inflation targets, and why falling inflation rarely makes life feel cheap again. This guide is general financial education, not personal financial, investment, tax, or legal advice, and its purpose is to make the system easier to understand without panic.